Guy maxes out his 401k every single year for 32 years, not a year missed. Starts at 25, retires at 57. Follows every piece of advice he ever got. Diversified, stayed the course, never panic sold. Wakes up the morning he turns 57, checks his balance, and sees $680,000. He was supposed to have $1.2 million. He can't figure out what went wrong. His financial advisor tells him market conditions. His HR rep says that's still a great outcome. Nobody tells him the truth. Nobody tells him about the $520,000 that quietly left his account 1/4% at a time for 3 decades while he wasn't watching. Another woman, smart, analytical, and accountant, sits down in her late 30s to actually read her 401k plan documents. Not the summary, the actual plan documents. She finds a fee schedule buried in a 214-page prospectus. Expense ratio, 1.3%. Administrative fee, 0.25%. Revenue sharing arrangement with the plan provider, another 0.15%. Total drag on her money, 1.7% per year. She runs the math on what that means over the next 25 years. She stares at the number for a long time. Then she closes the document, calls her HR department, and says she wants to move her money to the low-cost options. HR doesn't know what she's talking about. Her plan doesn't have low-cost options. Third person, 34 years old, same job as person 1 and person 2, same salary, same contribution rate. But he spent 3 hours one Saturday reading about expense ratios on index funds. He moved everything into a total market index fund, charging 0.03%. That's it. 3 hours, one decision, same income, same market, same 30-year window. His ending balance is going to look like a different planet. What's the pattern? It's not about discipline. All 3 of them were disciplined. It's not about income. They make the same money. It's not about intelligence. The accountant was the smartest one in the room. The pattern is a hidden tax that your employer, your plan provider, and your financial institution have a shared financial incentive not to explain to you. It's not a conspiracy, it's just incentives. And by the time you feel it, 30 years have already passed. My name is Tom, and I spend way too much time thinking about the machinery underneath financial products that everyone uses and almost nobody reads the fine print on. If you're someone who contributes to a 401k, has a 401k from a previous job sitting somewhere, or is about to start contributing and wants to understand what you're actually signing up for, subscribe and like this video. It will help more than you think. Before I get into the numbers, and we're going to get very deep into the numbers today, I built a free 401k fee calculator because everyone I found online either requires you to create an account, sells you something, or uses rounded figures that make the problem look smaller than it is. Mine uses Vanguard's cost comparison methodology to show you the actual dollar impact of your current fee structure over your specific time horizon. I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Here's the thing about fees that most people fundamentally misunderstand. When someone says your expense ratio is 1%, you probably hear 1% per year. That doesn't sound like much. And I understand that instinct. 1% sounds like a rounding error. But here's the catch. Fees don't just take 1% of your money. They take 1% of everything your money would have become. They eat the compounding. They don't just take from the principal, they take from the gains on the gains on the gains. Think about it like this. Imagine you have a snowball at the top of a mountain. It's going to roll for 30 years before it reaches the bottom. Every year, someone takes a small slice off the outside of the snowball before it rolls further. Doesn't sound like much, right? Except the part they're taking is the part that would have collected more snow as it rolled. By the time the snowball reaches the bottom, you're not missing a thin shell, you're missing a completely different snowball. That's the fee trap, and it's not accidental. The structure of the American 401k system was specifically designed in a way that made fees almost inevitable and almost invisible. To understand why, you have to go back to 1981, because what happened in 1981 is still happening to your retirement account right now. Before 1981, most American workers didn't think much about investing. They didn't have to. If you worked for a major company, a manufacturer, a utility, a bank, an airline, you were covered by a defined benefit pension plan. You worked for 30 years, you retired, and the company paid you a monthly check until you died. The math was the company's problem. The risk was the company's problem. Actuaries, portfolio managers, professional analysts, all of that was running in the background, and your job was just to show up and work. The pension was a promise. You earned it. It was yours. Here's where the betrayal story starts. In 1974, Congress passed ERISA, the Employee Retirement Insurance Security Act, which, among other things, included a provision called Section 401k. Originally, this was a minor tax advantage mechanism for executives to defer bonuses. Nobody paid much attention to it. Then in 1980, a benefits consultant named Ted Benna noticed that the language of the provision could be interpreted to allow any employee to defer a portion of their salary into a tax-advantaged account. He proposed this idea to his client. The IRS ruled it was permissible, and by 1981, the Treasury formally allowed it across the board. The corporate world moved fast, not because corporations suddenly cared more about their workers' retirement security, because defined benefit pensions were expensive, unpredictable. They required corporations to fund promised obligations regardless of how the market performed. They showed up as liabilities on balance sheets, and they were being strangled by rising interest rates in the late 70s and early 80s. The 401k offered something far more attractive to a corporation: transfer the investment risk entirely onto the employee. You pick the funds, you bear the volatility, you figure out the withdrawal strategy. The company matches a small percentage, the liability disappears from their books, and they call it empowering workers. Between 1980 and 2000, pension coverage among private sector workers dropped from 38% to 21%. 401k participation exploded, and here's who won. Financial services companies, mutual fund providers, insurance companies, plan administrators suddenly had access to trillions of dollars in assets that regular people were contributing to every paycheck, and they got to charge fees on every dollar every year for decades. The fee income this generated was enormous. By 2023, the 401k industry was managing roughly $7.7 trillion in assets. Even at an average fee of 1%, that's $77 billion per year in fee revenue. $77 billion annually extracted from American workers' retirement accounts. Here's who lost: the workers who thought they were getting a great deal because their company matched their contributions. The workers who didn't read the fee schedule, which, to be fair, was buried in documents they were never told mattered. And the retirees who hit age 65 with accounts 30, 40, 50% smaller than projections, because the math that was done for them at enrollment didn't include an honest accounting of fees. And here's the kicker: this entire system was legal. Every fee was disclosed, technically, in documents that were long, complex, and written in a way that required a financial law degree to interpret. Nobody went to jail, nobody paid a fine. The plan administrators collected their fees, the mutual fund companies collected their expense ratios, and American workers lost trillions of dollars in retirement savings that they will never get back. So what does this have to do with your 401k today? Everything, because right now, right this minute, most 401k plans in America still operate under a fee structure that significantly disadvantages the worker relative to what's possible. Here's what most people don't realize: the expense ratio on your fund isn't just a fund-level fee. Your 401k plan may be charging you additional layer fees that sit on top of the fund's expense ratio and are almost never visible on your account statement. Let me break down exactly what you might be paying. First, there's the investment expense ratio, the fee charged by the mutual fund itself. This is the number that gets advertised. In a well-run plan with low-cost index funds, this might be 0.03% to 0.1%. In a plan filled with actively managed funds, this might be 0.5% to 1.5% or higher. Second, there's the plan administrative fee, the cost of running the 401k plan itself, which covers record-keeping, legal compliance, and the technology platform. These fees are often charged as a percentage of plan assets and can add another 0.25% to 0.75% on top of fund-level fees.
Third, in many plans, especially at smaller companies, there are revenue-sharing arrangements where the mutual fund company pays the plan administrator a kickback, technically called 12B1 fees or sub-TA fees, in exchange for being included in the plan's fund lineup. This creates a direct financial incentive for plan administrators to choose higher-cost funds, not because they're better, because they share more revenue. Add all three layers together, and it's not unusual for someone in a mid-sized company's 401k to be paying 1.5 to 2% per year in total fees without knowing it. Now, let's run that math. Here's the protocol. Let's call her Sarah. She's 28 years old, she earns $75,000 a year, she contributes 10% of her salary, $7,500, to her 401k, and her employer matches 3%, so her annual contribution is effectively $9,750.